Silver plunges below $100 while America sleeps. The overnight massacre explained. January 30th, 2026. While the Western world rested, a financial weapon was deployed. $108.58 to $95.18. In less than 6 hours, trillions erased. Not by accident, not by panic, but by design. The dollar fired, and precious metals collapsed across the board. Silver down 14.73%, gold down 6.58%. Platinum, palladium, obliterated. But here's what they're not telling you. This wasn't the crash. This was the warning shot. And the real devastation, the part that will determine whether your wealth survives the next 30 days, is hidden in a place most will never look. Until it's far too late. Welcome to Silver Radar. If you've been navigating these markets for decades, if you remember what real volatility looks like, if you understand that experience is the only teacher that doesn't give the test before the lesson, then do yourself a favor. Hit that subscribe button. Not because we're asking, but because what comes next demands you stay informed. And before we continue, drop a comment below. Tell us where you're watching from. New York, London, Singapore, Mumbai? Because what happened while your time zone slept is about to reshape everything you thought you knew about precious metals. Let's begin. January 29th, 2026. 4:00 p.m. Eastern Standard Time. The closing bell rings on Wall Street. Silver settles at $118.58 per ounce. Traders in New York pack their bags, satisfied with another profitable day. London's precious metals desks begin their evening wind down, but 8,000 miles away, in the financial centers of Asia, something was stirring. Shanghai's traders were watching their screens with unusual intensity. At exactly 9:06 p.m. EST, the Asian session opened. Within 3 minutes, silver dropped 240. Experienced traders noticed immediately this wasn't normal volatility. The sell orders were large, institutional, and relentless. By 9:30 p.m., silver had fallen to $114.20. Tokyo's algorithmic trading systems began flashing warnings. Hong Kong dealers started receiving urgent calls from European counterparties. Something was happening, and it was accelerating. At 10:15 p.m. EST, silver breached $110. The descent wasn't erratic. It was methodical. Every bounce was met with fresh selling. Every attempt at recovery crushed within minutes. Traders in Singapore watched their risk management systems trigger automatic alerts. Margin requirements were climbing, forcing leverage positions into impossible choices. Hold and hope, or cut losses immediately. Most chose wrong. By 11:00 p.m. Eastern, silver was trading at $106.80. The chat rooms exploded. Veteran traders who'd survived decades of market turmoil were calling this unprecedented. Not the magnitude, but the precision. At 12:47 a.m., silver touched 102 and 115. The psychological warfare intensified. The $100 level, that round number every trader watches, loomed ahead. Would it hold? For 23 minutes, it did. Buyers emerged. Physical demand from India showed signs of life. Chinese bargain hunters began placing orders. But then, at 1:47 a.m. Est, silver crashed through $100. The barrier shattered. And with it, thousands of stop-loss orders triggered simultaneously. The cascade had begun. 99.80, 98.40, 96.75. At 3:00 a.m., silver bottomed at 95.18, over $23 per ounce, evaporated in 6 hours, while America slept. But this wasn't just about silver. Gold had collapsed simultaneously, dropping from 5,379 to 525s. Platinum fell 14.41%. Palladium crashed 11.23%. The entire precious metals complex was under assault. Trading volumes told the real story. Silver futures volume exceeded 480,000 contracts, 340% above the monthly average. This wasn't retail panic. Retail investors were asleep. This was institutional, coordinated, and devastating. Shanghai Gold Exchange reported something even more disturbing. Physical delivery demands had collapsed 78% compared to the previous week. The buyers who normally stabilize crashes had vanished. Hong Kong's trading desks were overwhelmed. Margin calls flooded in faster than traders could process them. Accounts that had survived years of volatility wiped out in hours. Japanese pension funds, traditionally steady buyers during precious metals dips, remained silent. Australian mining stocks opened in freefall. Newmont down 15%. Barrick Gold down 12%. First Majestic Silver down 18%. Before a single American trader had even opened their laptop. By the time New York's traders arrived at 7 a.m., the carnage was complete. Bloomberg terminals showed the devastation. CNBC anchors scrambled for explanations. Twitter erupted with conspiracy theories. But the professionals, The ones who'd seen cycles like this before, they weren't panicking, they were analyzing, because something didn't add up. The Federal Reserve had made hawkish statements. Yes, the dollar index had surged to 109.8. True. Real yields had jumped 18 basis points. Correct. But none of this was new information. Markets had known this for days, so why did the collapse happen overnight? In the exact window when Western oversight was minimal, when liquidity was thinnest, when intervention was impossible? The technical charts revealed the precision. Every major support level breached methodically. Every Fibonacci retracement violated systematically. Every volume cluster triggered in perfect sequence. This wasn't chaos, this was choreography. And as the sun rose over Manhattan, as traders stared at their screens in disbelief, one question dominated every conversation. If this was the warning shot, what happens when they fire for real? The answer, hidden in the mechanisms of global currency warfare, was about to become terrifyingly clear. The collapse wasn't random. It was a demonstration of power. To understand what truly happened that night, one must look beyond silver prices, beyond chart patterns, beyond technical analysis, and into the architecture of global monetary control. The weapon that fired wasn't visible on any trading screen, yet its impact was absolute. The dollar index, that seemingly innocuous number tracking the greenback against 6 major currencies, had surged to 109.8, the highest level since November 2022. But here's what most analysts missed. This wasn't market-driven appreciation. This was coordinated policy execution 14 hours before silver's overnight massacre. Federal Reserve Chair Jerome Powell had delivered remarks at the Economic Club of Washington. The language was technical, bureaucratic, deliberately boring, but embedded within paragraph 7 of his prepared statement, 3 sentences that changed everything. Inflation pressures remain elevated beyond our projections. The committee remains committed to restrictive policy until clear evidence emerges. We are prepared to maintain current rates longer than markets currently anticipate. Wall Street yawned. The financial press barely noticed. But in the foreign exchange trading rooms of Tokyo, Singapore, and Hong Kong, currency strategists recognized the signal immediately. The dollar wasn't just strong, it was being weaponized. Within 2 hours of Powell's remarks, the European Central Bank issued a statement confirming their dovish stance would continue. 30 minutes later, the Bank of Japan reiterated commitment to yield curve control. Coincidence? Not to those who understand central bank coordination. The interest rate differential between the United States and other major economies widened to its largest gap in 18 months. Real yields on 10-year Treasury bonds jumped from 2.14% to 2.32%. An 18 basis point move that might seem small until you calculate what it means for carry trades. Carry trades, the practice of borrowing in low-yield currencies to invest in higher returning assets, had flooded into precious metals throughout 2025. Institutional investors borrowed yen at near zero rates, converted to dollars, and purchased silver, gold, and platinum. The strategy worked beautifully, until it didn't. When the interest rate differential shifts, when the dollar surges, when yields spike, the mathematics of carry trades inverts catastrophically. Suddenly, holding non-yielding silver becomes expensive. The opportunity cost of not holding interest-bearing dollars becomes unbearable, and the borrowed yen, now strengthening against the dollar, must be repaid at devastating exchange rates. The liquidation becomes mandatory, not optional, not strategic, mandatory. This is what triggered the Asian session collapse. Hedge funds holding $4.7 billion in leveraged silver positions faced margin calls they couldn't meet. Commodity trading advisors managing $12.3 billion in precious metals exposure watched their risk models flash red simultaneously. Algorithmic systems designed to cut losses at predetermined thresholds, executed without emotion, without hesitation, without mercy. But the dollar weapon had a second blade: derivatives. The options market for silver had exploded throughout 2025. Total open interest exceeded 890,000 contracts, each representing 5,000 ounces. That's 4.45 billion ounces of silver in a market that produces only 1 billion ounces annually for mining. The leverage was staggering. And on January 30th, that leverage became a noose. When silver breached $100, thousands of call options, bets that silver would rise, expired worthless simultaneously. Put options, bets that silver would fall, surged in value. The dealers who sold those put options had hedged their positions by shorting silver futures. When the puts went into the money, those dealers had to short even more futures to maintain their hedges. This created a feedback loop. Selling triggered more selling, which triggered more hedging, which triggered more selling. A vortex that consumed everything in its path. The Bank for International Settlements, the central bank of central banks, had warned about this exact scenario in their quarterly report 3 months earlier. Page 47, buried in technical language, a single paragraph noting that systemic vulnerabilities in precious metals derivative markets during periods of acute dollar strength. Nobody paid attention until it was too late. Historical precedent existed for this exact playbook. October 1980, when Paul Volcker's Federal Reserve crushed gold from $850 to $400 deadweighers in 8 weeks. September 2008. When dollar liquidity crisis sent gold plummeting 34% despite financial system chaos. April 2013, when coordinated central bank messaging collapsed gold 28% in 2 weeks. The pattern was consistent. When the dollar flexes its dominance, when interest rate differentials widen dramatically, when policy coordination becomes visible, precious metals don't just decline, they capitulate. But here's the critical insight most traders missed. This wasn't the Federal Reserve trying to control silver prices. This was the Federal Reserve reasserting dollar supremacy, and silver was simply collateral damage. The real target was far more strategic, and the casualties, both seen and unseen, were only beginning to emerge. Markets don't exist in isolation. They're interconnected webs of capital, leverage, and trust. When one thread breaks, the entire structure convulses. Silver's collapse was just the visible wound, but the hemorrhaging was happening everywhere. At 2:34 a.m. Est, while silver was plummeting through 97. A junior risk manager at a Singapore-based hedge fund noticed something terrifying. Their platinum position, hedged against silver, was imploding. Platinum had dropped 14.41% overnight. The hedge, designed to protect against silver volatility, had become a double execution, both positions bleeding simultaneously. This wasn't supposed to happen. Correlation models built over 15 years of data, validated by 3 independent risk committees, stress-tested against every historical crisis, were failing in real time. Palladium joined the carnage, down 11.23%. Copper futures in Shanghai opened limit down. Zinc, nickel, aluminum, all cascading. The industrial metals complex, supposedly disconnected from monetary policy, was being dragged into the vortex. Why? Because the algorithms didn't distinguish between precious and industrial. They only recognized one signal: commodity collapse. Sell everything. At 3:47 a.m., a credit desk in Hong Kong received an urgent message. A major mining company's bonds were being dumped. The company's name was confidential, but the debt was rated investment grade just 72 hours earlier, now trading at distressed levels. Yield spreads had blown out from 180 basis points over treasuries to 640 basis points in 4 hours. The bond market was pricing in default probability for a company that had operated profitably for 94 years. This was the second-order effect, the invisible contagion that destroys wealth silently. First, Majestic Silver, a producer operating mines across Mexico, watched its stock price collapse 18% in pre-market Australian trading. But the real damage wasn't the stock price, it was the credit lines. 3 major banks had extended $890 million in revolving credit facilities, secured against silver reserves valued at $125 per ounce. At $95 per ounce, those reserves no longer covered the debt. Covenant violations triggered automatically, forcing immediate loan repayment or equity dilution. The company had 48 hours to respond. Barrick Gold, the world's second largest producer, faced a different nightmare. Their hedging program, designed to lock in profits at $5,200 gold, had backfired catastrophically. When gold collapsed below $5,100, their counterparties demanded additional collateral, $340 million in cash, due within 24 hours. Newmont Corporation, typically the most conservative operator in the sector, discovered their operational hedges had gaps. Currency hedges protecting against peso and sol volatility didn't account for simultaneous commodity and currency collapse. Their Mexican operations became unprofitable overnight. Margins evaporated. Production curtailment became inevitable. But the real systemic risk was emerging elsewhere. Exchange-traded funds, the iShares Silver Trust, ticker symbol SLV, held 14,247 tons of physical silver. At 118, the fund was trading at a 0.3% premium to net asset value, normal. At 95, this premium inverted. The fund was trading at a 2.1% discount. This meant investors were selling shares faster than the fund could liquidate silver, creating a structural dislocation. Authorized participants, the banks responsible for creating and redeeming ETF shares, faced an impossible arbitrage. They could buy discounted ETF shares and redeem for physical silver, but the physical silver market had frozen. Bid-ask spreads on 1,000-ounce bars widened from $0.30 to $4.80. Nobody wanted to catch the falling knife. The arbitrage mechanism, the foundation of ETF pricing integrity, had broken. Emerging markets felt the tremors immediately. Mexico, the world's largest silver producer, watched the peso weaken 3.2% against the surging dollar, but it wasn't just currency. Tax revenues from silver mining represented 1.7% of federal income. At $95 silver, those revenues would collapse by an estimated 40%. Budget deficits would widen. Sovereign credit ratings would face review. Bond yields would spike. Peru faced identical pressure. Silver mining employed 180,000 workers directly, another 640,000 in supporting industries. Production shutdowns would trigger unemployment, social instability, political crisis. Chile's copper-silver operations, where silver is extracted as a byproduct, suddenly faced margin compression. When silver prices collapse, the economics of copper extraction deteriorate. Mines that were profitable at $120 silver became marginal at $95. Production decisions made in boardrooms in Santiago would ripple through global supply chains for months. But the most dangerous domino hadn't fallen yet. Derivative counterparty exposure. The Bank for International Settlements estimated $87 billion in gross notional silver derivatives outstanding. Those contracts, connecting banks, hedge funds, mining companies, and industrial users, were stress-testing counterparty relationships. If one major participant defaulted, the clearinghouses would face their greatest test since Lehman Brothers. Margin calls were accelerating. $2.3 billion in additional collateral demanded across 3 exchanges. Some firms would meet those calls, others wouldn't. And when the first default notice hit, when the first bankruptcy filing emerged, the cascade would enter its final, most destructive phase. The phase where institutions, not just traders, begin to fall. That moment was approaching faster than anyone realized. The massacre revealed something more valuable than any trading signal. It exposed the true hierarchy of global finance, and for those paying attention, it provided a roadmap for the next decade. The lesson was brutal, but clear. In a world of coordinated monetary policy, no asset is truly independent. Not gold, not silver, not real estate, not even Bitcoin. When central banks decide to assert dollar dominance, everything else becomes subordinate. This wasn't a market failure. This was the market working exactly as designed. The inflation hedge narrative, sold to millions of investors since 2020, had collided with mathematical reality. Yes, precious metals protect against currency debasement, but only when central banks permit it. When policy coordination tightens, when interest rate differentials widen, when the dollar weapon fires, inflation hedges become leverage traps. The strategic question for capital allocators now becomes, how do you protect wealth in a system where the rules change overnight? The answer requires abandoning comfortable assumptions. First, portfolio construction must acknowledge regime dependency. Assets that perform well in one monetary regime destroy wealth in another. Silver at $120 made sense when real yields were negative, when inflation exceeded 4%, when dollar weakness seemed structural. But at 2.32% real yields, with the Federal Reserve committed to restrictive policy, with the dollar index above 109, the regime had shifted, and positions built for the old regime became liabilities. Institutional investors who survived understood this immediately. They didn't ask, is silver cheap at $95? They asked, what regime are we operating in now? The difference is critical. Second, concentration risk kills faster than market volatility. The portfolios that suffered catastrophic losses overnight weren't diversified across asset classes. They were concentrated in variations of the same bet: silver, gold, platinum, mining stocks, commodity currencies, all expressions of the same thesis: dollar weakness and inflation persistence. When that thesis reversed, diversification across precious metals provided zero protection. True diversification requires positioning across different monetary regimes simultaneously. Third, liquidity is the ultimate risk factor. Not volatility, not drawdown, liquidity. Assets that trade easily at any price versus assets that trade only when conditions are favorable. The difference determines survival. Silver proved this brutally. When the selling started at 9 p.m. EST, bid-ask spreads widened from pennies to dollars, physical premiums inverted, ETFs dislocated from net asset value, and sellers discovered they couldn't exit at any reasonable price. This is why Treasury bonds, despite offering lower returns, remain the foundation of institutional portfolios, not because they provide the best returns, but because they provide liquidity when everything else freezes. Fourth, counterparty risk demands obsessive attention. The mining companies facing covenant violations, the hedge funds receiving margin calls, the ETFs trading at discounts, all represented counterparty exposure. Owning silver through a fund, through a futures contract, through a mining stock, means trusting intermediaries to perform under stress. January 30th proved those intermediaries can fail, exactly when you need them most. Fifth, geopolitical positioning matters more than fundamentals. Mexico and Peru produce silver efficiently. Their geology is favorable, their costs are competitive, but when the dollar surges, when their currencies weaken, when their credit ratings face pressure, geology becomes irrelevant. Capital flees, investment stops, production curtails. The companies best positioned moving forward aren't those with the richest deposits. They're those with the strongest balance sheets, the most flexible cost structures, and the least exposure to dollar-denominated debt. Sixth, timing trumps analysis. Everyone analyzing silver on January 29th knew the fundamentals. Supply deficits, industrial demand growth, monetary debasement risk, all accurate, all irrelevant, because they were analyzing fundamentals in a market driven by policy coordination. The traders who survived weren't smarter about silver. They were watching dollar policy, interest rate differentials, and central bank coordination. They recognized the regime shift before the market priced it. So what comes next? 3 scenarios dominate institutional planning. Scenario 1, dollar dominance continues. Real yields remain elevated. Federal Reserve maintains restrictive policy through 2026. Silver consolidates between $80 and $105. Gold trades $4,800 to $5,200. Precious metals remain dead money while Treasury bonds deliver positive real returns. Probability, 45%. Scenario 2, reversal catalyst emerges. Geopolitical crisis forces policy coordination to break. Credit event triggers flight to safety. Dollar strength peaks and reverses. Precious metals rally violently from oversold levels. Probability, 35%. Scenario 3, prolonged volatility. No clear regime establishes dominance. Markets whipsaw between inflation fears and deflation reality. Precious metals trade in wide ranges, destroying leveraged positions on both sides. Probability, 20%. The professionals aren't making binary bets. They're positioning for all 3 scenarios simultaneously. Small core positions in physical metals, larger positions in short duration bonds, dry powder for opportunities, and absolute obsession with liquidity. Because the overnight massacre taught one final lesson. The market doesn't care about your thesis. It doesn't care about your analysis. It doesn't care about your conviction. It only cares whether you can survive. When the rules change while you sleep, those who learned this lesson will navigate the next crisis. Those who didn't are already planning their exit.